Hello, this is the lecture for Monday, September the 14th, and we will be finishing up chapter 4. So, we ended up looking at the statement of stockholders' equity. That was the last thing that we had looked at. So we need to talk a little bit about additional balance sheet disclosures, and there are a number of things that have to be disclosed with respect to the balance sheet. An educated user really needs information that's in the disclosure so they can properly evaluate the financial position of the corporation. All right, so the first thing that you'll usually find in the disclosure section is a summary of accounting policies. It'll show you the method that the corporation chose for a particular item, such as what method of depreciation or what inventory method they're using to account for inventory, and then anything else that's particular to them. All right, financial instruments, whether or not they evaluate them at cost or present value or fair value on the financial statement, they have to show for financial instruments, they have to disclose the fair values, okay, of all financial instruments, no matter what they chose to put them at on the face of the balance sheet. Okay. Let's see. Any derivative instruments have to be disclosed. Derivative instruments are usually held to account or to make up for any risk that they might have with respect to various financial instruments. All right, another one that you need to be aware of are loss and gain contingencies. So sometimes things happen, they hinge on something that's going to happen in the future, and you don't know whether or not you should record it on your balance sheet or not. All right, so if you're going to record a loss contingency, then there are a couple things that have to be met. First of all, is it probable that it's going to happen? Yes. And notice that it's an and here, okay? And you can estimate the dollar amount. If it meets both those requirements, then you should recognize it in the financial statement. So basically, you'll have a loss on your income statement and some sort of liability on your balance sheet in relation to it. All right, now accountants want to be conservative, so that's why we want to recognize these losses. However, since we're conservative, you don't ever recognize gain contingencies. So let's put that in there. Gain contingencies are not recognized until realized. So that means until it actually happens, okay? But you would recognize the loss contingency if it meets both of these requirements right here. It's probable that you're going to incur the loss, and you can reasonably estimate the dollar amount. All right, a subsequent event is another thing that's probably new to you. We haven't really talked about it in any other accounting classes prior to now. A subsequent event is something that happens after the end of the year, so it happens after December 31st and between when the financial statements are issued. So let's say my financial statements aren't issued until March 1st, and something happens in late January that affects the numbers that I have on the balance sheet that ended December 31st, okay, of that year. So if it happens subsequent and it affects something that existed at the balance sheet date, all right, so something already existed. So let's say that somebody sued me and I recorded a loss contingency because I wasn't sure if I wanted to record loss contingency because I didn't know the dollar amount, let's say. Well, let's say the court, it's been decided and I now know how much I'm probably going to have to pay. That existed at the balance sheet date, so I need to go back and adjust that number, okay? If it doesn't affect the financial statements, then you have to disclose it even so. And then probably in a pro forma statement as well. So you would show, you would redo the financial statement as if it had happened, but it would just be in the notes. Related party transactions are typically need to be disclosed. A lot of times related party transactions happen between corporations who are related. So like you've got subsidiary corps that are all owned by the same parent. Those are related corporations and they would be related parties. So just to make sure that everything's, as it should be, and that it was conducted at arm's length, then you need to disclose the nature of any relationship, the nature of any transactions, the description, the dollar amounts of them, and then any amounts that are due or from related parties on your financial statements. All right, now, generally speaking, comparative financial statements are issued along with the annual report. So really, anytime a corporation issues financial statements, you normally have comparative financial statements. For a balance sheet, they'll normally issue 2 years worth, the current year and the previous year. Okay, and it's actually required by the SEC. So for the balance sheet, it's 2 years. For the rest of them, it's 3 years. So the income statement, statement of cash flows, and statement of owner's equity or shareholders' equity, it's 3 years. Many things have to be disclosed for a 5-year period. So just kind of keep that in mind, maybe up even to 10. And I think we're going to stop that one there. But look for another one. I'm going to do another little lecture on financial statement analysis.